Hi, I'm Francis. So let's start. I'm going to present a crypto-based peer-to-peer lending introduction and issues. This topic is not a good topic. I want to change it to crypto-backed peer-to-peer lending. So this is more precise, and then you will see why. So the motivation is that, okay, borrowing and lending is the basic form of finance. So it's very interesting. Human beings start to do this kind of activity many years ago, before Christ, 1,000 years in Mesopotamia, that people find some, they love to record everything on their mud plates, right? Including their lending contract. So that's why we know there are some lending activity and borrowing activity. They used to borrow and lend commodities. So imagine in the farming society, it's important to keep everyone alive, right? Because we need the human power to farm. So if one family is lack of, let's say, grains, they will starve to death, and then the society will just crash. So this is the basic lending system. At that moment, there was already interest rate, but there's no such a concept called collateral yet. But it's the basic form of borrowing and lending. So we move to modern days lending system. We have different kinds of borrowing and lending. The lenders are usually banks or institutions. So this is the difference between a peer-to-peer lending and a modern day lending system, that in a peer-to-peer lending, individuals can be lenders, individuals can be borrowers. But usually in a modern day lending system, we call the lenders, the lenders are usually banks or institutions. For example, you want to buy apartment, you won't go to your friends to ask for their money unless your friend is very wealthy. So people usually go to bank to have a mortgage. And then now we have a modern day peer-to-peer lending. We just discussed with in the discussion room that, okay, lending club just closed. But the lending club is actually one example of the modern day peer-to-peer lending, that those companies are the platforms that match the borrower and lenders together. So imagine you have a borrower, let's say a shop that needs some money to get some goods to sell. Then they can publish a lending request, a loan request onto those systems, stating all the interest rate, all the terms, all the collateral, all the stuff, all the information, and then individual borrowers, actually, like individual folks like us, we can go to such a platform and then give the money to the platform, and the platform give the money to the borrower. So now we move to a new stage, a new era of lending. That well, if you come now, people can use cryptocurrency as a collateral in order to borrow money from anyone. So those companies are international platforms as a matchmakers and the protocol providers, that they control the process of borrowing and lending. They control how much collateral is needed. They control what is the interest rate. They control all the custodian activity of the borrowing and lending process. In this case, the borrower, actually the lenders and the borrowers, they don't need to give any information of their own. Because we are in a crypto world, that the cryptocurrency wallet can be anonymous, right? So it's quite interesting to see that all the previous system of lending requires information of lenders and borrowers, right? But in a crypto-based peer-to-peer lending, the borrower and lender can be stranger to each other, right? The only trust they have between, the borrower and lenders is the collateral in this case. Yeah, so the next is all about trust, right? To make sure borrower will repay. In the classical lending, It's a combination of measure, right? First of all, you have a collateral. For example, if you go into a mortgage, the apartment will be the collateral. If you cannot repay, the bank will will sell your apartment, right? And the second one is the lenders and borrowers, they know each other, right? The banks know everything about you. They can always trace you, hunt you down if you don't pay, you don't repay your debt. And the third measure is the reputation. So actually before Lehman Brothers, the good rating banks can borrow even without collateral, because the banks know if they don't repay, they lose their reputation and they can hardly get a good deal of borrowing later on. And the fourth item is the law enforcement, of course. If you don't repay, the lender can file a bankruptcy order from the court. So you need to go to bankrupt. But in crypto-based peer-to-peer lending, we don't have such a thing called law enforcement, reputation, or information exchange, anything. So to make sure the borrower will repay, the crypto-backed peer-to-peer lending solely rely on collateral. So in this case, the borrower used the crypto assets as collateral, and then the lenders ask for a haircut. That means the value of the collateral is always higher than the outstanding debt in any time. So if you think of the reverse, if the outstanding debt is larger than the collateral, then the borrower has no motivation to repay, right? And the lender has no measure, because the lenders cannot force the borrower to honor the lending contract at all. So now this is the problem that is quite interesting, that we are going into some new kind of lending process that the collateral plays a very important role in this process. So you might ask, does the market exist? I would tell you yes. There are quite a lot of platforms that provide such a peer-to-peer crypto-backed lending. So this is Aave. They have a market size of this, Celsius. And I would like to talk about Phonomics. So Phonomics is a cryptocurrency exchange that if you are familiar with, if in investing, you know what is a margin trade, right? So those cryptocurrency exchanges provide a peer-to-peer margin trading system. So in the classical margin trade, for example, IB, if I want to do a margin trade, then I'm actually borrowing from the IB system instead of anyone. But in Phonomics or other cryptocurrency exchange, actually we are borrowing from other investors. So it's quite interesting that now it's the peer-to-peer lending, but now it's a peer-to-peer margin system. And then we have other platforms. And then they show some quite a large amount of processed loans. So there exists a market of such a crypto-backed peer-to-peer lending. So this is the motivation. In this talk, I will talk about, okay, what is the crypto-backed, what is the crypto-based peer-to-peer lending contract? And then I will talk about two issues. And then if I have time, I will go through some hands-on to show you how those platform works. So take a Coin Loan as an example. If you go into their web page, you can immediately see a calculator like this. So on the left-hand side, we have the loan size. And then you immediately know what collateral you need to pledge in order to borrow this amount. And then we can control of the loan term. So the loan term range from 7 days to actually 1 year. This is, sorry, not 1 year, so to 3 years. And then of course we have the repayment options, whether you want to pay the interest only or you pay the principal plus interest every time point. So it's like a repayment schedule. The important thing here is that this is called the initial loan to value ratio. So this is now 70%. That means our borrowing size, this 10,000 US dollar, is 70% worth of the collateral amount. So now the collateral is Bitcoin, right? That means this amount of Bitcoin worth 1 over 0.7 worth of this 10,000 euro. Sorry, not euro, 10,000 US dollar. So actually, coin loans offers different fiat currencies, crypto, and stable coins. And then there's no credit checks or whatsoever. And then they use the collateral as the security. So this is the calculation. This is the formula of the loan to value ratio. The loan to value ratio is just the outstanding debt divided by the collateral value. So please be aware that we have a subscript T here because this LTV ratio will change across time. So imagine you have a fixed outstanding debt, but you have, let's say, some Bitcoin, you have some large volatility in the Bitcoin, then your collateral value will change dramatically if the Bitcoin price change dramatically, right? So this is a variable. This is something will change across time, this LTV ratio. So what is connected to the LTV ratio is something called liquidation procedure. So as I just said, the outstanding debt must be always smaller than the collateral value. So in order to enforce such thing, the contract or the system or the smart contract will liquidate the collateral from time to time if the outstanding debt divided by, the outstanding debt is too large or the collateral value decrease, right? So in coin loan, they say if the LTV ratio hits 80%, we enter to a danger zone. So at this point, the borrower can react and choose from three actions. Of course, he or she can put down more cryptos, so to lower the LTV, right? Or he or she can pay back part of the loan, or he or she can do nothing. But then if the LTV ratio keep growing, like to 90%, then the collateral is automatically liquidized. So it's solely controlled by the system. So this is quite a danger, which you will see later on. This liquidation procedure, we try to send cryptos or sell it to the market to recover the lenders, to fill the outstanding debt of the borrower. So the lender at this point can receive some value, some of the coins back in this case. And the liquidation threshold can be written in USD or the borrowing coins. So it looks like this. So the first issue of such a crypto-backed peer-to-peer lending is, well, as I just said, the collateral is the only thing that the borrower and lender relies on, right? But now we have something very risky. The exchange rate of crypto assets are known to be very volatile. If you compare the quarterly German housing price index, it's like this, right? But if you compare the daily price of a Bitcoin, it grows like this. You might ask, okay, this is a quarterly data, this is a daily data, but housing mortgages is like a 30-year time frame. So and then for the crypto-backed peer-to-peer lending, it's like from days to year, a 1 year time frame. So I think this is a valid comparison, but you can see how volatile cryptos are, but people are using it as the collateral. So this is a major conflict of, not a conflict, but an interesting thing to discover, to investigate. So this implies that the trust between the lenders and borrowers is also very volatile, right? So this comes to a second issue. I call it a batch liquidation. So what happened here is that borrowers borrow Bitcoin using CLAM as collateral through a phonomics in the margin trading system. So we all know Bitcoin, right? But CLAM is something, it's just yet another cryptocurrency invented by someone. The background is that this CLAM was developed in order to be the chips in a casino, in an online casino. So can you imagine that people using casino chips as collateral to borrow Bitcoin out of it? In May 26, 2019, there was a sudden crash in the price of the CLAM market. And then this crash lead to an automatic liquidation by the system, because the LTV ratio shoot through 90%, right? And then the system just sell clams to the clams market. And then this further lower the clams price. And then this is some kind of chain reaction that causing this clams market just, I call it vaporized, because now it's just disappear, clams. You can see the price like this, a sudden crash from here, and then there's some rebounds, and then just, it never go up again if you check the current price. And then lots of the trading volume is contributed by the automatic system. So this is some kind of a new systemic risk. It's some kind of a new machinery of the systemic risk. So as the result, 16.2 of the entire margin lending pool was vaporized. And then this affect 0.4% of all Phonomics users. So how much time do I have?
Sorry, Francis, you have 3 more minutes.
Three more minutes. Maybe I'll show you the main results. So I run a back test onto Bitcoin market. So I originate one peer-to-peer lending contract every day at a closing price of T. And then I set every contract with an initial LTV ratio of 70%. And then the liquidation threshold is 90%. And then what I did is to record the liquidation process triggering points and their corresponding contract start dates. So this is the interesting result. This is the price, of course. And then those dots are the liquidation triggering points. And then darker the points, more the contracts are liquidated at that day. So if you look at this chart, we have a contract start day, and then we have a BTC trading day. So you can see those liquidation come in batch, right? So those contracts originated at this time frame are liquidated at a much smaller time frame. So this is actually a big problem, that if we involve the market impact to the back test, we will see some interesting, I will skip those things. The slide will be shared, right? Yeah, then I will share the slide. But this is some interesting results that the peer-to-peer lending market can eventually vaporize the Bitcoin market if the peer-to-peer lending market is big enough. So this is some results. Sorry for the quick skipping a lot of slides, but yeah. Maybe I do a little conclusion. So the conclusion is that trust between the borrower and lender depend only on the collateral. And the collateral now we are using is very volatile. And then we see some batch liquidation phenomena and some potential market run. So the outlook is that actually we need to somehow price this kind of a systemic risk. So this is the outlook. So thank you very much for your attention. So I welcome questions.
Thank you, Francis. Do we have questions from the audience?
Hi everyone, it's Cristina. Can you hear me?
Yes.
Yeah.
So thank you very much for a very, very interesting talk. It is indeed a pity that you couldn't go through all your slides. Definitely, maybe you should present it like in a sort of 1 hour talk, because it's certainly very interesting.
I'm sorry.
I'm just very curious. So how often is the lender in the danger zone, actually? If you could reveal a little bit more of those LTV ratios, because the volatility of these cryptocurrencies, as you mentioned, it's very unpredictable. It's not only that it's high, but it's highly unpredictable.
Yes.
So if there are some extra credit risk management measures taken in addition to these LTVs ratios and to defining danger zones, because clearly if you think at credit risk management measures, this is not enough.
So you're asking for some data set from those peer-to-peer lending sites?
If you can show how these LTV ratios, how volatile they are, and so.
The unfortunate thing is that they don't reveal any of the data of those contracts. But I can show you. This is a Bitfinex. So they now have a liquidation feed. They record. They show to the user. They show to the trader that when those liquidation happen and by how much. So this is one data we can get from. Another data is that this is from Afair. So they have an API that show all the available liquidation. So this is what the data we can get. And then I'm actually collecting it. So maybe I give you an update when I have well, because there are lots of platforms, but maybe I keep you an update if I have.
Very good to get the slides. I think everybody is very interested in getting all the slides, Ala, and we are happy we get it. But the very last question to conclude, how do they manage this market? Because it's apparently increasing, given this huge volatility and huge exposure to credit risk. So are there really some extra credit risk management measures besides the danger zone definition? No. Okay. Well, we live in a crypto world. So thank you very much.
Everyone are anonymous. So some people call it it's like a repurchase agreement market. So this is information insensitive market, right? So this is related to something called a systemic risk. So we can see a large potential, a great potential that certain part of the peer-to-peer lending market crash, and then it will like a chain reaction to move the underlying collateral market. So this is quite interesting.
What is the volume of this type of peer-to-peer market versus the classical peer-to-peer market? You gave us on the slide the clear volume in billion US dollar for the first. But what about this crypto market?
For example, this Afair, you can see different coins available for lending and borrowing. So this is the market size in terms of maybe in terms of US dollar.
Okay, thank you, Francis. But we need to move to our next speaker.
Let's talk in the meeting room.
Yeah, you can discuss in the meeting.